Trading at highs last seen in March, the US dollar, also a major overhang on gold prices, may be losing ground, says our next guest. Joining us now is Axel Merk of Merk Investments. Axel, a long time. Thank you for being back on the show with us.
Great to be with you again.
So Axel, you say the end of the dollar's dominance may be unfolding right before our eyes, but it might not be because of another currency, but rather because of money market funds. Why is that?
Yes, so sorry for jumping into this arcane topic, but I think it's hugely relevant. Money market funds became fashionable in the early 70s, as you might know. That coincided with the end of the gold standard, the last bits of it anyway. And what I'm alleging is that money market funds used to be a little bit like Fannie and Freddie. They used to appear as safe. You remember, you got your money's worth back. There's a stable net asset value of one and so forth. Well, in recent years, regulators have been thinking about changing the rules, and they were fully phased in at the end of last week. And what the implication of that is that money market funds are no longer as interested in as they used to be in providing funding to just about everybody in the world. In 2011, money market funds had about half of their holdings in commercial paper issued by European banks, US dollar denominated paper, obviously. So foreign banks got their funding through US money markets, not just foreign banks, foreign corporates, foreign sovereigns, and many others. And now that these rules have changed in institutional money market funds, that funding source is drying up. LIBOR rates, the cost of funding for investors or for borrowers, if they don't have access to the Fed, has been rising and rising. And in my view, that's exactly the result of these things. Now, the implication of that is that it used to be, so to speak, a subsidy, I interpret that at least, to get money from the money market funds. And now that that is gone, there's much less funding going to take place in the US dollars, and that threatens the US dollar.
So bring it back to basics here for us, Axel. What does this mean for gold?
Well, for gold, it ultimately means that gold will be less manipulated in some ways. The world will be functioning a little bit more normal because not everybody is going to chase to the dollar to get their funding. But what that ultimately means is that the cost of borrowing is going to go up for many players, including players in the US, including ultimately also the government. And what that means is that if the Federal Reserve doesn't allow the cost of borrowing to go up, the cost is going to be too low, meaning that there's going to be negative real interest rates that are too low. That in the medium term is a positive for gold. And so that doesn't exactly mean tomorrow gold is going to skyrocket, but it's going to be huge changes in the world and how the world finances itself. And ultimately, because we have too much debt out there, central banks are going to try to prevent that from happening, and that process is good for gold.
Well, let's play out the scenario that the Fed does have a rate hike, in December. How will that affect gold?
Well, if you have a quarter-point rate hike every 12 months, I don't think that's a big threat to the price of gold. Think about it. If you think inflation is going only up 0.25% a year, then yes, then run for the hills. But if you think that inflation is creeping up at a faster rate, then it is more what I think is that the Fed is firmly behind the curve. And we'll have these bouts where they think that, oh my God, the Fed is suddenly so tough. Well, if you think the Fed is going to be tough, that means real interest rates are going to go up substantially. Then gold is, I believe, at risk. That said, I think that the Fed, and Yellen just spoke about it again, that they are looking for yet new reasons to not raise rates or to be very slow in raising rates. That doesn't mean a rate hike won't come. But I believe the reason why people continue to buy gold is because they just don't believe that the Fed wants to get ahead of the curve. I think they're formally committed to be behind the curve, meaning that inflation can continue to move higher. And in that sort of environment, gold should do just fine.
All right, Axel, just to wrap here, any surprises we can expect from the ECB meeting on Thursday?
Well, Draghi is reasonably happy where things are. I do think the one surprise that people may not appreciate or not have priced in is that I think we are towards the bottom of the interest rate cycle in Europe. Draghi last time said that the fragmentation in the Eurozone is pretty much gone. You may agree or disagree with that, but that pretty much means you don't need much additional stimulus. The market is pricing in a continued aggressive easing. And so as people will, quote unquote, normalize those views, I do think that's going to be good for the euro probably and bad for the dollar, and by implication, it might be good for gold as well.
Axel, thanks so much for joining us today.
My pleasure.
And thank you for watching this edition of Kitco's Gold Report. We'll see you tomorrow.